Ladies and gentlemen, boys and girls, cats and kittens, welcome back to the podcast. Thank you. We're having an interesting Bitcoin day. I swear the only reason that I keep putting these things up is I want to catch like that God candle, either up or down, and I want to be live when it happens. So that's why I keep the Bitcoin chart up there, even though I'm not a monstrous Bitcoin investor. So, all right. Anyway, guys, today we're talking about something that affects your wallets a hell of a lot more than you think. It's behavioral economics in finance. I understand these are not thrilling. I consider this the most valuable information that this channel puts out, are these evergreen videos right here. Gotta ask, do you ever wonder why you splurge on stuff that you don't need, or panic sell your tokens at the worst time? It's not just math. It's your brain messing with you. Now, if you could please stick around to find out how, hit that like button. And if you enjoy it, let's go ahead and jump right into it. 10 seconds, guys. All right. So what is behavioral economics? Traditional economics assumes we're all rational, like robots, calculating the best financial move. But behavioral economics says, oh no, we're absolutely human. It's the study of how emotions, biases, and quirky thinking shape our money decisions. Think of it as psychology meets finance. Now, Nobel Prize winner Daniel Kahneman helped kick this off, showing we're not as smart with cash as we think. Now, let's start with a big one. And this really is the tip top, and it's called loss aversions. Studies show we hate losing money twice as much as we love gaining it. Imagine your token drops 10% and you panic sell to avoid more pain. But if they rise 10%, you're chill, just waiting for more. That's loss aversion screwing with you. It's why people hold losing investments too long or dump winners way too early. Our brains are wired to dodge regret, not to maximize profit. Next up, overconfidence. Boy, this is right up my wheelhouse here, man. Have you ever met someone who thinks they're a token picking genius? They're not. Research shows that most traders overestimate their skills, guys especially. In one study, 74% of investors thought that they could beat the market. Spoiler, most don't. Overconfidence makes us take dumb risks like YOLOing into meme coins or day trading with rent money. We're not as clever as we feel. Then there's herd mentality. Everyone's buying Bitcoin or buying GameStop or buying Tesla. Behavioral economists, they call this social proof. We assume the crowd knows something that we don't, but crowds can be wrong. Now, I want you to think way back to the 2008 housing crash. People piled into mortgages because prices always go up. They don't. Following the herd feels safe, but it can lead you off a cliff. I want to say that one more time. Following the herd feels safe, but it damn sure isn't. So, how do these biases hit finance? Let's take the crypto market. It is a roller coaster of human emotion. When prices soar, greed and overconfidence fuel bubbles like the dot-com boom in the way back. When they crash, fear and loss aversion trigger sell-offs. Even pros aren't immune. Fund managers chase trends all the time. And what about the everyday folks? We're impulse buying crypto or hoarding cash under mattresses instead of investing wisely. Now, let's look at 2021. Let's get real here. Because crypto craze, Dogecoin, spiked because people saw others cashing in. Herd mentality, check. Or think about panic during a recession. People pull money from markets, locking in losses, thanks to loss aversion. Behavioral economics explains why we don't buy low, sell high. We're too busy freaking out or we're flexing. So I know that this is not exciting stuff, but we can fix it. We can kind of fix it. Awareness, that's step one. Knowing you're prone to herd behavior might stop you from buying at a peak. Setting rules like only sell if X happens. It cuts emotional decisions. Apps like robo-advisors help too. They take the human craze out of investing. But let's be honest, we'll never be robots. That's what makes finance fun, and that's what makes it frustrating. So, look, man, here's the takeaway. Behavioral economics shows finance isn't just numbers. Our biases, fears, and dreams drive markets as much as data does. Understanding this won't make you a billionaire overnight, but it might save you from a few dumb moves. Next time you're eyeing a real hot token or stressing a dip, ask, is this me or is this my brain? So, again, guys, I know this is not the most exciting stuff, and people tend to tune in over here to any kind of YouTube video to say, what should I buy? What should I sell? When should I buy it? When should I sell it? Nobody can give you those answers. Nobody can give you those answers. It takes a lot of research, a lot of luck, or a lot of experience to kind of dial it in. With the current state of the market, all we're trying to do is minimize losses right now. Nobody's killing it. We're all just trying to minimize losses. Got to do that smartly as well. So anyway, if there are any other questions, comments, concerns, or observations, right down there, guys, Scott@ThePodocasts.com. I'm more than happy to answer any and all of them. This is kind of what we do. Bella and I will be live tonight, 1800 Central. I'm not sure if we have a guest or not. I hope we do. But if not, you just catch us. We're going to be doing our thing like we always do. And that's it. So until next time, guys, please stay safe. Please be smart with your money. Cheers.